Hello YouTube, it's Victoria from TRADEPRO Academy, and I'm excited to bring the last lesson, the last part of our Forex mini-series, and it is the US dollar index lesson. The US dollar is a very important tool in trading Forex, and the index is very, very important, as you guys will see in just a moment, how it affects our Forex trading, our strategy, and how we look at Forex as a whole. So let's jump right into this, guys. The US dollar index, the DXY, as you might find it on TradingView. It started in 1973 at a value of 100. So since then, it has moved above that level and beneath that level. This generally reflects how much it has gained or lost since its existence. So let's say the value today is 94. That means it's lost about 6% since the start. If it was at 114, it would have gained 14% since its beginning. Lows ever were around 80 around the 2008 crash, when there was a lot of easing pressed into the US economy. We will look into this a little later on. The high was around 164. The index represents the US dollar strength in value compared to other currencies. So that means this dollar index is pinned against several currencies, and each currency has a different weight, with the euro weighing in the most, considering it is a massive economy, the eurozone, like we talked about in our previous lesson, the euro USD. So the basket of currencies against the US dollar index are as follows: the euro, Japanese yen, British pound, Canadian dollar, the krona, and the Swiss franc. The dollar in comparison to these currencies creates the dollar index. Dollar index reflects a general strength of the US economy, not to take it too literally, of course. So a hawkish standpoint would be good for the dollar, meaning increased rates. They're increasing generally because the economy's booming, it's doing great, as we do see in recent months. As Jerome Powell, the US Fed, a dove, has been raising rates, pressing the dollar higher in quick bursts, while a dovish standpoint is not so great for the dollar, as you will see. This is generally because of easing and pressing money supply back into the economy, lowering rates and effectively lowering the cost of borrowing. So let's look at some historic examples below as promised. So right here might be a little blurred, but this is a general timeline of the US dollar index. You can see the high here just above 160, which happened around the 80s. And then right here, this is what I was talking about, the financial crisis and quantitative easing, the housing bubble. So this is when the quantitative easing began. This means lowering rates, pressing more money into that economy. And you can see it actually broke beneath the 80 mark before climbing back into near the 100 value mark territory, as we are right now, pretty close to that. Like we said, the US dollar index is used as a gauge, and we like to use it in Forex trading to see how the major pairs might react in coming weeks. If the dollar index is strong, we could expect US-based pairs like the USD Japanese yen to press higher. So let's jump into TradingView and we will look at some examples for you guys. Right here on my screen, to the left we have the Euro USD, and to the right we have the dollar index. You can see, since the base pair is the euro, it is a pretty much exact inverse correlation. So when we do our analysis, we'll go into different time frames and see how the US dollar has reacted this week and what we could expect in the next week. You can see it's pressing here, lower lows, lower highs. We could maybe draw a potential down channel, which means that the USD might be looking to bounce a little lower, meaning that this pair right here, the Euro USD, will press higher, considering they're inversely correlated. So what we'd like to see is maybe a break of this bottom down here for a break of this high. Again, this bottom right here is substantially lower than this high is, higher on the Euro USD. We can look at another pair just for an example. Right here, the USD CAD maybe. So the USD CAD on a daily looks pretty similar to the US dollar index as expected right here. If we could break these lows, we could see a potential break of these lows on the USD CAD to continue a little lower. If we do rally from this support, we could expect a rally in the USD CAD. But again, this was a little vague tutorial for the real deal, for a great price action strategy using the US dollar index and major pairs, or even just other currency pairs. Jump into our Forex course where Mark, TradePro's professional Forex trader, dissects the price action strategy using the dollar index to successfully trade Forex pairs. So guys, I hope you enjoyed this little mini series. It was Victor from TradePro Academy. This was supposed to be a little introduction to the world of Forex and the major pairs and how we look at them to trade them successfully. So if you like this video, drop a like, comment, subscribe, and once you've subscribed, hit that little bell to go live with us every morning in our trading room where we trade futures successfully with the rest of the TradePro family.